Hey, it's Jim, and this is level 1 of the CFA program, the topic on fixed income and the learning module on fixed income securitization. I'm going to go ahead and begin with one of my simple, silly stories that really will act as a summary of securitization. In fact, it's almost everything that you need to know about this learning module. So let's go ahead. I want you to play the role of a banker. I know many of you are, but I want you to think about what your life is like. What do banks do? They accept deposits and make loans at its simplest level. So let's suppose that you as the banker, you make a bunch of loans, short-term loans, medium-term loans, long-term loans. And every day you come into the office and you get out your Excel spreadsheet and you take a look at the list of all of the individuals and businesses that owe you interest and principal, and that is due today. So what do? You get in your car, you drive all around the city, and you go collecting interest and principal from all these people and all of these businesses. Now you become friends with these people, right? You know them. Most of them, they pay freely and happily. Some of them struggle a little bit. And then, boy, you're never happy when those individuals and businesses say, you know what, I just don't have it this month. I might not have it next month. So you're completely stressed out at the end of every day. So in order for you to manage this stress, you stop off at the local market and you buy a Honeycrisp apple and you eat this apple and it just re-energizes you for the next business day. And you do this over and over and over again. All right. So then after one particularly bad day, on your way home, you stop at the market and the market no longer sells individual Honeycrisp apples. It now sells them in bags of 30. Now you love these Honeycrisp apples and you think, all right, I'm going to buy this bag. You take the bag home, put it in your refrigerator, and now you don't have to go back every day to get your Honeycrisp apple. So as you're laying in bed that first night, you're thinking to yourself, wait a minute, there's a lesson in here to be learned. So you go into work the next day and you take a look at your Excel spreadsheet and you pick 30 mortgages that are similar in size. The borrowers have similar credit ratings. They're in similar geographic areas. And you say, you know what? I wonder if I can put these 30 mortgages in my Honeycrisp apple bag and sell them. So you put them in a bag, you go out to the parking lot, you put a big ad out there and you say, for sale, 30 mortgages. And you're not quite sure if anybody's going to be interested in this. But before you know it, there are thousands of cars in the parking lot. And they're all interested in this because businesses and individuals, they don't have exposure in their investment world to the mortgage market. But now you, because you're a Honeycrisp apple fan, have increased the spanning. That's what we call it in the academic world. You've introduced another security that's available to them. Now, if the present value of those mortgages, let's say, is 100, some people might come in and offer you $90 for the bag. Some people might offer you $100 for a bag. But here's the cool thing. Some people might offer you $110 for the bag. So you say, sure, here's the bag. And you say you want to wash your hands of all of this collection stuff. But those investors, they look at you and they say, you know what? Who's going to collect all this interest in principal? And some of them might say, hey, will you do it? And you'll say, sure, I'll do it. But now, since you paid me all this money, remember that includes principal and interest, you can now hire somebody else to drive around the city and collect. Or you can say, there's a third party over there. I know a really good dude. Let's hire him to do it. Or, and this is not very likely, you could tell the investors, you guys do it yourself. So notice that everybody is happy here. You're happy as the banker. Your assistant is now happy because you hired somebody else. The investors are happy because they've achieved diversification. The investing market is happy because you have provided them with another security out there. The economy is happy because now we're growing. How about that for a nice simple story? This is all fixed income securitization. Everybody's happy. And this learning module pretty much goes with the idea that everyone is happy. Now, we'll talk in a later learning module specifically about mortgage-backed securities, about why some people aren't happy. So here we go. Benefits of securitization. I just did that. Describe securitization, including the parties. I did that pretty much on a broad level. Now what we'll do is go into a deep level. So clearly, when you get to the exam question, think of a bag of Honeycrisp apples sold to a bunch of investors out there. But the cool thing now is that you have all these different mortgages in your Excel spreadsheet. And so you can put Honeycrisp apples into a bag and people will buy it. But what you can also do is you can divide those Honeycrisp apples into quality. At the very top, you could have, the perfect Honeycrisp apples. And then as you go down, maybe some have a little brown spot on them. Maybe some at the bottom have worms in it. Maybe there are ants crawling around. Sometimes you could even put oranges and kiwi into this bag. I mean, you can sell this bag of loans that include almost anything. What did I say just a moment ago? Everybody is happy, including the farmers. All right, so let's look at the securitization process before we examine the benefits. All right, so pools and transfer of ownership generating a cash flow. This makes perfect sense, right? There's that bag. So somebody buys that bag of Honeycrisp apples, but those Honeycrisp apples now are the homeowners or the automobile owners or business loans or whatever kind of loan that shows up on the left-hand side of the bank's balance sheet. So there we go, loans or receivables. Now, what I didn't describe in that original example was that typically what happens is that you don't just sell the bag out in your parking lot and hand it to the individuals or the business. You need to create a special legal entity. So you just think about it, there's a tent out in your parking lot and you go into the tent and that tent is its own special and unique legal business and entity. So that legal entity has its own balance sheet and income statement. So what happens then is there's a flow through that legal entity. This is called off balance sheet financing. So that tent doesn't appear on the bank's financial statement. So then this entity issues securities that are backed by these pooled assets. So they could be short-term, they could be medium-term, they could be long-term. But typically these are the bonds that are issued by the special legal entity. And the proceeds of that bond issue then is used to purchase the mortgages. So the actual cash flow that I described in my first example is a little bit more complex. And then there you go at the bottom, those cash flows, they pay interest and they pay principal. So everybody that's in your parking lot, whether it's a hedge fund or a mutual fund or an individual, these people, they receive interest in principal. So they have exposure to the mortgage market, the auto loan market, to receivables, to whatever is out there. Now we put this flow chart in here specifically because not only is it in the learning module, but there are 2 questions at the end of the learning module that provide the candidate with a flow chart. And there are a bunch of ovals and a bunch of squares and a bunch of rectangles. And each of those are numbered 1, 2, 3, 4, 5, all the way up to 9 or 10 or 11. And the question is, which one of these is the special purpose entity? And the other question is, I forget the other question. Which one are the investors? So you have to know the flow, 1, 2, 3, all the way to 10. And this pretty much summarizes it just a little bit. So just think of exactly what I was saying here. There's the original source. We pull them together with similar features. So this is what I was saying about, the very first 30 Honeycrisp apple bag. All those Honeycrisps, they pretty much look the same, right? But they have similar features, but they're not going to have identical features. So you transfer that into the special purpose entity, which is this legal new business. And so what happens then? It issues securities to the investor, an asset-backed security. And then those investors, the bondholders, the individuals or the mutual fund or the hedge fund, they now have exposure to this, whatever that asset is. Here's another good simple flow chart here. Here are the original borrowers down in that left. What is that? Kind of a reddish pink, all the way up to the green. There's you, right? You were playing the role as the banker. What do? You go out and you create this tent in the middle of your parking lot, this special purpose entity or special purpose vehicle. And then that special purpose vehicle then has all of the people in the parking lot, attracted to the tent. So it's in your parking lot, it's your tent, and these are the asset-backed security owners, but they're really not a part of the bank because the tent doesn't show up on the bank's financial statement. All right, so how about this idea of a pass-through security? So this is exactly what I was saying earlier. The cash flows then from all of let's just do mortgage-backed securities, from all of the homeowners, right? What do? They make interest and principal payments, and they flow right to the tent, right? This special purpose vehicle. And then the tent then pays interest and principal to all of the investors out there, a pass-through security. And so that makes perfect sense. And the really cool thing about this, and we'll learn this in the later learning module, but we do a little bit of it here, is that you can chop that bag up into almost any kind of a slice that you want. That slice is called a tranche. And so you can say something like, look, we're going to get all of these interest and principal payments, but the first people who get paid, let's just call this tranche A, the first people who get paid, they're going to get just interest. The second people who get paid are going to get interest and a little principal. The third group of people who are going to get paid are going to get paid interest and a little more principal. And then you see how you can slice these tranches into almost any number that you want. I mean, not 1 million, but certainly 4 or 5 is not unusual. And that bottom tranche is always often called the equity tranche because it's like the last thing that gets paid. And so imagine that if you slice this in its most efficient way, the investors who prefer these specific slices. Now back in this next learning in this next learning module, we're going to talk about contraction risk and prepayment risk. So some investors, they want lots of interest early. Some investors, they don't want any interest right away. So imagine that those people will pay extra to get what they want. So that's what I was saying earlier. Some investors will offer 90, some 100, some 110. So this is really, really cool stuff. But what happens then is that it's really just a pass through. There we go. Look at the bottom left, off balance sheet, independent entity. The investors' payments vary on the pool's credit risk and the payment patterns. This is what I was saying about with the tranches. Now, go back up to the top here. There's this concept of a covered bond, which is mostly in Europe. What they typically do is they use a specific mortgage pool as collateral, but the assets remain on the bank's balance sheet. So that's probably the really good question there. Remember, covered bond, the tent is not out in the parking lot. The tent is now inside somewhere, and it shows up on the balance sheet. Now, here's this idea of an illustration of the pool and this pass-through structure. So here we go, mortgage 1, mortgage 2, mortgage 3. And of course, there's not just 3 mortgages. There could be 30 in our example, just because I picked 30 because there were 30 Honeycrisp apples in our original bag. Could be 300, could be 3,000, could be 3 million. Probably not 3 million. That's probably too many. So that goes into a pool, right? That pool is created through this pass-through security, and the tent fits in there somewhere. So there are the investors. Now, these structural enhancements are some extra things that can go into each of these different tranches. There's the word tranche in the bottom. What's that? The second column. So this offers predictable payments. So think about if you're a credit card investor and the bank issues one of these asset-backed securities through credit cards, well, you know as well as I do that sometimes you pay the full balance of your credit card. Sometimes you pay 3/4, sometimes you pay 50% and 25%. Sometimes you just pay the minimum amount. I'll go ahead and wag my fingers at you. Please don't be paying just that minimum monthly payment. But what happens then is there's tremendous uncertainty about what's going to flow to you as the investor. So what these structural enhancements will do is say different tranches. You can say, hey, you know what? In this first tranche, I want all the money from the people who pay off their loan, right? So they pay, maybe they don't even have any interest, right? So the credit card balance gets paid to you. And maybe that's what you want because you want to build a swimming pool in your backyard and you want to do this next week, right? So you'll have that first tranche. But then people down at the bottom, maybe they don't want any payments. Maybe they'll say something like, you know what? Don't pay me anything for 5 years. And so you have this zero coupon tranche at the bottom, but maybe you only pay $500 for that equity-like tranche, and with the promise that you'll get $1,000 in, whatever it is, 5 years or 8 years or 20 years, right? So what this does is that it divides each of these tranches by risk, and so the potential investors can then pick their tranche. And the great exam question, I'm not sure this is a level 1 question, but this is clearly a level 3 question. The great question is to say something like, here we have a client with this return objective, with this tolerance for risk, which tranche is appropriate? Now, the Institute doesn't get too far involved in that question, but hopefully you can see that that's the important question that we're going to get to as we move through the program. All right, let's go ahead and focus on mortgage-backed securities here for just a second. And I'm not sure I'm going to add anything to your knowledge based on what we've just talked about over the last 15 or so minutes. So specifically backed by a pool of mortgage. Yeah, so what happens here is that the issuer, right, the financial institution, it can boost the profit because those things then are in the tent. There's less capital needed. This increases the efficiency, right? You don't have to get in your car and drive all around the city collecting those payments. Now, of course, that's a silly part of the example. Nobody gets in their car and drives around. It's done all electronically. But still, you're sitting in your office and you're still stressed out about whether or not the individuals and the businesses are going to make those payments. And there's one that I like in the bottom, the purple. When I started paying attention to this stuff, maybe 35 years ago or so, if you looked at a financial institution's income statement, at the very top, it would say something like interest income. And then it would say fees and other kinds of revenues. Excuse me. Well, back in the old days, the interest income was about 90% and the fees were about 10% or so. Now, it's not that it's totally reversed, but it's about half and half. So extra income from fees down the bottom. That's probably important. And then I really love this last one here. Think about this. You sell those loans to the tent. So you get that capital right now. So you can expand your lending capacity. Now you can do what you need to do as a banker, right? You were hired as a banker to evaluate the credit risk of these borrowers, and so now you can expand your lending capacity. What do the investors get out of this? What did I say earlier? They line up and they pick their tranche, right? So they find an outlet that gives them the risk exposure that they demand. It also, and this is probably look at the bottom left there, this is probably the most important one, it increases their ability to diversify their portfolios. So I like that one. This is what I was saying earlier. Look at the top right. Customization of risk profiles, higher returns, and match maturities with a pension fund. I mean, think about it. If you're a pension fund manager and there's a mortgage-backed security with 3 tranches, what you can do is you can say, hey, I got these people here. They're retired, so I need tranche 1. And I got these people over here. They're going to retire in 3 to 5 years, so I need tranche 2. These people over here, they may never retire, so I'll do tranche 3. So pension funds, they love these mortgage-backed securities. And then ultimately, what was that word that I used earlier? Spanning, right? We're increasing the number of securities, the types of securities available for the investing public. So what that has to mean, it has to mean that there is greater liquidity, right? You got more securities from which to choose, a quicker market response, and then the potential for higher returns because of all of the matching. Now, how about economic and financial market benefits here? Creates tradable securities, boosts liquidity. We already said that. Alternative funding method. Yep, we said that. Moves loans off the balance sheet. Yep, we said that. Increases market efficiency. Did we say that? Not so much, but go back to Eugene Fama in 1970 with the efficient markets hypothesis. What did he teach us? That every security is the present value of the expected cash flows, and that price is an efficient price if it reflects all relevant and publicly available information. So think about this. When you have a mortgage-backed security or any other asset-backed security, and you have investors out there who are coming in to buy it in your parking lot, well, the investors are not going to come in and be completely ignorant of the residential or commercial real estate market. But they're not going to be complete experts on it either. So they're going to do their research. We're going to bring Moody's and Standard & Poor's and Fitch into the whole model because they're going to rate these bonds. So you have all these extra people in here focusing on the residential mortgage market and the commercial mortgage market. Well, there has to be an increase in market efficiency, and that pricing mechanism then should be a revelation of all of this information. Cheaper funding, that makes sense, and then diversification once again. All right, how about this securitization overview? So all we're going to do is we're going to convert these things, all of these accounts on the left-hand side of the bank's balance sheet, into tradable securities. This has to benefit everybody out there. What did I say earlier? That this learning module really focuses on the benefits, not so much the costs associated with this securitization. Now, remember I said these investors are going to pick these tranches over here. What they're probably going to do is they're going to say, you know what, we have this investment horizon of 10 years. Therefore, what's the duration of this tranche? We want to pick that duration of 10. So what it does is it generally, not in all cases, but it generally reduces that duration gap, the difference between an investor's horizon and the duration of a bond. So what happens here? We have several things. You have the seller provides collateral. You have the special purpose, this collateral issues the asset-backed security. And then you have the servicer. That could be either the bank or a third party or anybody else out there. So here's what I would think is probably the least likely, or how about if I just say the least interesting question, LOS here, including the parties and the role they play. So potential guarantors. So you have other people out there who are going to come on, other businesses, other financial institutions who are going to say something like, you know what, if this doesn't work out, we'll go ahead and pay it. You have accountants and lawyers and underwriters, trustees, ratings agencies. So you have all these different people who are interested in the mortgage market or the asset market. And those people here, let me go back here. These people here, they add to the, where was I? Look at that fourth one down here. All of those people add to this increase in market efficiency. Now, of course, I'm not a lawyer, nor do I want to be, and the Institute really doesn't want us to be, but they want to ask the question, what is the role of these key legal documents? So this is about the tent out there. What is this special purpose entity, special purpose vehicle? And, over the years, I'm guessing you guys know this, these special purpose entities, they've expanded to include, almost anything. In the 2020s, there were a bunch of these created to facilitate merger and acquisition activity. And some of those are pretty successful, but if you're regular readers of the Wall Street Journal, some of them have been failures. All right, so this legal document, what does it do? It ensures the asset quality. Oh my gosh. What I want to do is, going back to 2005 and 2006, I want to cross that word ensuring off, because clearly there are some consequences when individuals buy these asset-backed securities, and they pay too much because they thought there was low risk involved. But this is a really good exam question. What is the legal document? I mean, of course, it's there to ensure asset quality. And so inside of this legal and binding document, there'll be a prospectus, just like there is for every other security out there, and it'll tell you everything that you want to know about the structure and the payments and the tranches, and if there are credit enhancements, if there are call features, if there are put features, whatever else is thrown in there, you'll be able to read about it. Now, here's a good and interesting and likely question here. What's the role of this special purpose vehicle? Legally protects, right? Separates the issuer from everybody else out there, right? It's a separate legal entity out there, which means that the tent can go bankrupt or the bank can go bankrupt, and neither one is supposed to impact the other's bankruptcy. Cheaper way of raising funds, limited to loan defaults for that credit risk. Now you need to go ahead and throw this other one in here. The Institute is not forgetting about third-party risk in here, and so there might be some of that, but credit risk is pretty much the ability of the homeowner or the automobile owner or the business to repay the loan. Yeah, so this is a true sale. Notice we have that in quotations. True sale, meaning that there's a full legal rights transfer, legal ownership of the assets. Yeah, look at that third one there. They might be contested in courts as fraudulent. You read the Wall Street Journal pretty regularly, and you'll read about this. Whenever somebody loses money, they just sue everybody, and so this SPE might be liable. I'm not sure that's a really great question, but notice we put the might be in italics, so just remember that. And of course, the last one there, these legal frameworks, they vary across boundaries and countries. So I'm guessing the Institute would probably say something like, in this particular country, they believe in this and this and this, and that would lead you to the correct answer. So there we go, 2 learning outcome statements. Should be good. I want you to go to, like always, to the end of this learning module. The reason I like these questions is because there's a really simple question, number 1, and then there is a vignette. So the next says, these following questions are based on this thing here. So you have a big old paragraph, and then that's where you have to answer the questions with the 2 flow charts. So go ahead and work on that. I think there's less than 10 of them in this one. So it shouldn't take you probably not even 10 minutes to do this. So, hey, thanks for watching. Have a great day and good luck studying.